So we're starting with financial reporting straight up, going into the discussion. So this is July 2024, the Chief Examiner's report. So there are just a few things I want you to take note of the Chief Examiner's report on financial reporting. The first one is going to be the pass rate. That's about 35%. And that is the average pass rate, 35%. So for the July 2024 examination, the pass rate was 35%. What does that mean? It means that if 100 people sat for the exam, 65 of the people failed. If 1,000 people sat for the exam, 650 of the people failed. So it tells you that the pass rate was pretty slim. But what was the concern of the examiner really when it comes to financial reporting? What was the examiner's concern when it comes to financial reporting? So the examiner raised just one concern here that I want us to really highlight on as we position ourselves to go into the examination. And so the examiner said that the above weighting indicates that the content and application of IFRSs constitute about 70% of the syllabus, and that hardly can a candidate pass the financial reporting paper if he or she does not put premium on the learning of the IFRSs. 70% of the questions relates to IFRSs. And so the examiner is saying that, hey, listen, if you want to pass the examination, you have to be strong in the accounting standards. If you want to pass the examination, then you have to put premium on the accounting standards, because that is the only way you can pass the exam. And here we are seeing 70%. Now, I have said this over and over again to students. And so once you are reading it from the examiner's report, you know that this is what we are talking about, 70%. And so the question people ask is, all right, Nhyira, how do I learn the accounting standards? What accounting standards must I focus on to increase my chances of passing the examination? I tell students this when it comes to the accounting standards. And so, and as I said earlier, corporate reporting also the same thing, because in corporate reporting, we're going to be understanding our understanding of accounting standard is also going to play a crucial role. In other words, if we are strong in the accounting standards, then we are likely to go and pass the corporate reporting examination. Because business valuation, accounting standards, we are likely to call on accounting standards. Business reconstruction, it depends. The footnotes, we are likely to call on an accounting standard. The issue in respect of ratios analysis, consolidated financial statement, evaluation of financial statements, all of these will call for accounting standards. And so passing the financial reporting or corporate reporting examination would depend on your ability to understand the accounting standards. And so the question then is, all right, how do you learn the accounting standards? What accounting standards must you focus on to increase your chances of ultimately passing the examination? Now, I have mentioned this previously, and I'm going to be saying it again, that the accounting standards are, if you want, symbiotic. What does that mean? It means that the accounting standards are interconnected with each other. And so the way you learn the accounting standards is to know how the accounting standards are interconnected. And many a times students tell me that, hey, Nhyira, the reason why the accounting standard is difficult, the reason why I'm not able to learn the accounting standard is because it's a lot. And I'm like, yeah, but you're supposed to know all of them before you go to the exam hall. So without an in-depth knowledge of the accounting standards, you're going to screw it up in that case. So what accounting standards do we look at, and how do we study the accounting standards? You want to look at the grandpapa of accounting standards, and that is IAS 16, Property, Plant, and Equipment. Now, when you take IAS 16, Property, Plant, and Equipment, there are a number of things that you need to understand here. Because for the most part, if you take any accounting standard at all, what is going to happen is that we're going to be having the initial measurement and subsequent measurement, definition, key terminologies that we have to define, the recognition criteria, disclosure requirements. So if you look at it carefully, the objective of the standard, key definitions or terminologies that we must know about, the recognition criteria, the initial measurement, the subsequent measurement, and disclosure requirements. So almost every accounting standard you pick, these are the 6 things that you must know about, because the examiner can come from any of these 6 areas in respect of a given question for you to write on. And so when we pick IAS 16 property, plant, and equipment as, say, a starting point, we need to know about the initial measurement. Now, if you're a good student from the financial reporting class, measurement is the determination of the monetary value at which an item will be carried in the financial statement, whilst recognition has to do with the incorporation of the transaction into the financial statement. So we have the initial measurement, and then we come to subsequent measurement. So the question we ask ourselves is, okay, on the initial measurement, what accounting standards must we be mindful of? If you remember in IAS 16, if you don't remember, I'm explaining again to you here. The initial cost of an asset shall be the purchases, the manufacturing, or the construction cost, plus any other directly attributable cost incurred in bringing the assets to its present use. So any costs we are incurring to bring the asset to its present use or condition will be included in the initial cost of the asset. For this reason, there are a number of accounting standards that are going to be coming to town on the initial measurement of property, plant, and equipment, and that is number 1, IAS 37 provisions. Because in accordance with IAS 37 provisions, where there is a present obligation for an entity to make a payment in the future in respect of an asset that they have installed or they have purchased, then the standard states that we must discount that payment into present terms, and that present value amount must be included in the initial cost of the asset. And that is where IAS 37 is going to be coming to town. Then certainly on subsequent measurement, we'll calculate the finance cost or winding, which will go to the P&L account. But in the initial measurement of an asset, we are going to be seeing that IAS 37 is coming to town, and we have to know about it. Not only that, we're going to talk about IAS 19, employee benefits. Now, when we pay wages and salaries to employees, normally relating to the day-to-day running of the organization, that will be written off in the profit or loss account. Okay, so we pay wages and salary to employees. That will be part of operation expenses or administrative expenses, will be written off in the statement of profit or loss and other comprehensive income. But if the payment we are giving to employees relates to the manufacturing, construction, or building of an asset, then the salaries will be included in the initial cost of the asset, and that is in accordance with IAS 19, employee benefit. That's another thing we need to understand. Number 3, we're going to talk about IAS 23, and that is borrowing cost. Now, if an entity borrows money to run the day-to-day affairs of the entity, then the interest expenses will be written off in the P&L accounts. As always, it will be part of finance cost, written off in the statement of profit or loss and other comprehensive income. But if the entity borrows the money or use the borrowed fund to acquire or construct a qualifying asset, then IAS 23 states that the interest expenses relating to the period where there is an activity ongoing, expenditure is being incurred, and borrowing cost is being incurred, then the borrowing cost relating to that, the construction of this asset or building of this asset, will be capitalized, or if you want, included in the initial cost of the asset. So borrowing cost is a basic accounting standard that we need to know about. Then we come to IAS 20, accounting for government grants and disclosure of government assistance. If an entity receives grants in respect of acquisition of assets, there are 2 ways the grants will be treated. It can be written off against the cost of the asset or recognized as a deferred income. And so if we are going to go with the grants being written off against the initial cost of the asset, then initial measurement, IAS 20 is going to be coming to town, and we got to be mindful of that. Not only that, sometimes we could buy an asset and the transaction is denominated in a foreign currency. And so we have to apply IAS 21 effects of changes in exchange rate so that the asset that has been bought, which was bought in a foreign currency, will be translated at the exchange rate or using the exchange rate at the date of the transaction. And that becomes the initial cost of the asset. And so, again, you see, this is one thing you must understand. The accounting standards, as I said earlier, they are intertwined. And so you must know when which accounting standard is coming to town. Because sometimes one of the questions that people also ask me is this: Nhyira, I've read the question, but how do I know this is the accounting standard in the question? You see, if you read a question and you don't know which accounting standard is in the question, it means you don't understand accounting standards. Let's take that again. If you are reading the question, the examiner says, explain how this should be accounted for in accordance with IFRS. And you've read the question, you've read the scenario, but you don't know which accounting standard to apply, it means you are weak in the accounting standards. Why? Because if you are strong in the accounting standards, there are keywords, phrases, terminologies, statements, clauses that when you read, you will know that, oh, this one is talking about this accounting standard. This one is talking about that accounting standard. And so that is the concept here. So you must know when which standard is coming to town and how to apply the principles based on the scenario under review. And that is what you need to understand. So on the initial measurement of property, plant, and equipment, we can come in with 37, 19, 23, 20, 21. And that is very important for us to know about. And sometimes our OG accounting standard will come to town, which is IFRS 13, fair value measurement. Because if we have to determine the fair value of the asset for initial recognition, maybe we are translating from investment property to a PPE, or we are translating from others class of assets to PPE, then IFRS 13 is going to be coming to town. So on initial recognition, these are accounting standards that are on their own, but they also have connection. They have relationship, if you want, with property, plant, and equipment, and that could affect the amount at which we initially measure or recognize property, plant, and equipment. Then we come to subsequent measurement. Now, on subsequent measurement of PPE, an entity has two options. Either they will use the cost model, which means the asset will be carried at the historical cost, less accumulated depreciation or impairment losses, or they will carry the asset at the revaluation model or at the fair value, which means that the asset will be carried at the revalued amount, less any depreciation or impairment losses. But irrespective of the method or the model being used, you realize that the asset has to be depreciated. And so it is important we understand the various methods of depreciation. We have the straight line method, the reducing balance method, the sum of year decades method, and other forms of methods that can be used to depreciate assets. But on subsequent measurement also, there are a number of accounting standards that you need to be mindful of, because irrespective of the method we are using, we may have to test for impairment. So IAS 36, impairment of assets. That's a basic accounting standard you need to look out for. Not only that, on subsequent measurement, the entity may revalue its assets. Now, when an entity revalues its assets, then it is important we know the tax implication. All right? It is important we know the tax implication. So IAS 12 will come to town, and that is going to be income tax. We have to know about it. Because when an entity revalues its assets, it's likely that the carrying amount will be greater than the tax base, which is going to result into deferred tax liability, because that is going to be taxable temporary difference, or the carrying amount is less than the tax base, which is going to result into deferred tax assets, because that is deductible temporary difference. And so IAS 12 could come to town. Income tax, we need to know about it. 3, it is likely that we have to talk about IFRS 5, non-current assets held for sale and discontinued operation. Because if a property, plant, and equipment that an entity is using, and they decide that they want to sell they want to sell it, and they have decommissioned it so the asset is available for sale, the entity is looking for a buyer, then they expect the sales to be completed in less than 12 months. That means they're going to now move from IAS 16 to IFRS 5, non-current asset held for sale and discontinued operation. Then also we can talk about the issue in respect of IAS 40, investment property, because again, on subsequent measurement, an entity may decide to stop using an asset as an owner-occupied asset and start using it as a non-owner-occupied asset. And in that case, it is important we understand how to account for such assets as well. So just for trial purposes, you seeing what's happening here. So that, how many accounting standards are we seeing here? So we are seeing 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 accounting standards. 11. Now, we have to understand them in their own rights, but we need to also know how these standards connect with IAS 16. And that's how you learn the accounting standards. So it's not like, yo, I finished reading IAS 36, Allah Wallahi. I finished reading IAS 19. Chale, if it comes, I'm going to do it. Nah, bro. Do you really understand how the standard relates to other accounting standards? Then once you are through with these guys, there are some 3 parties. They go together if you want to. So we have the connected accounting standard, 3 of them, and that is IFRS 16, leases, IFRS 15, revenue from contract with customers, and IFRS 9, financial instrument. Now, one thing you must know is that there is a high probability that the examiner will bring a question about one of these guys, or all the 3. All the 3 will be applicable if we have a leases question and it's a sale and lease back. Then we would have to apply IFRS 15, IFRS 9 to determine whether performance obligation has been satisfied or whether it is not a sale, so then it is a financial transaction and the asset was used as a collateral facility, in which case we continue to account for the asset in accordance with the applicable accounting standard. And so these 3 accounting standards, you have to know about them. So what am I trying to let you know here? What I'm trying to let you know here is that, yes, as per the Chief Examiner's report, you cannot pass financial reporting and by extension, corporate reporting without an in-depth understanding of the accounting standards. And the accounting standards are not difficult. They are not difficult. If you want well-structured content, also tailor-made, then you can decide to enroll in our course and get access to all of our premium content as well, available on the Nhyira Premium mobile application. Because we organize everything and discussed everything in respect of the accounting standards, solving questions, and you'll be able to join our live lectures as well to be able to solve questions so you can understand the basic principles that relates to the accounting standards. Now, certainly there are other accounting standards like IAS 2, inventories, IAS 41, agriculture, IAS 8, accounting policies, changes in accounting estimates and errors, IAS 10, the events after the reporting period, IAS 38, intangible assets, IAS 33, earnings per share, and these are the accounting standards that you must know about before you head into the exam hall. But whether you like it or not, we have to be strong in the accounting standards. And so the clue then is, all right, you have to sit down and study the accounting standards.